Hello, I'm Valerie Leonard, and welcome to EverThrive's market update for the month of February. There's certainly a lot going on in the news, and I'm here to break everything down so that you can get clear and objective information because I just want you to be able to make informed and confident decisions about your money. So, here's 5 things you need to know this month. As a quick preview of what's top of mind for investors and also for our clients, this is what we're going to cover today. We're going to talk about the US dollar, the potential impact of tariffs, how inflation is trending, what we might expect in the future on the tax front, what risks in the market are signaling caution lights at the moment, and what you may want to know and possibly even do when thinking about your next investment moves. First of all, the US dollar has continued to remain strong since the beginning of the year relative to other currencies like the euro, the Chinese yuan, the Japanese yen, and even the Canadian dollar and the Mexican peso. So, what will happen next? That's what's on everybody's minds, of course. If you read Trump's executive order on tariffs, there's no need to guess at what may happen next because the order is actually pretty clearly stated. The US is in a better negotiating position than China and Mexico because their economies are in a slump. The Chinese know that any deal that the US will put out there or any deal they may reach is going to take a while to resolve, but they seem to be more willing to negotiate than they were in Trump's first presidential term. Later in the video, I'll talk more about what you can do amidst these negotiations. But before that, let's take another look at inflation and how tariffs are related while also considering the role of the Fed. The Federal Reserve is responsible for monitoring two main things. We've talked about this before. They look at inflation and also the labor market. Now, January's employment reports revealed weaker payrolls than expected and also higher wage growth, meaning that Americans' income is rising. That costs more for businesses, of course. There were also downward revisions to prior data in previous months. So that has indicated that hiring isn't really as strong as what was initially reported in prior months. Now, currently, the unemployment rate is sitting at 4%. Now, the Fed's not going to like the fact that wages are up while the labor market is cooling because that combination really isn't great for the economy. So, when you add tariffs to the equation, which also have the potential to drive prices up further, my view is that inflation will continue to trend higher by the end of this year. As a result, the Fed won't be compelled to cut rates despite Trump's adamant requests. I believe that Trump is concerned about the impact of tariffs on inflation, and maybe he's wanting rates to be cut sooner rather than later to help balance those effects. However, the Fed looks at recent data to make decisions, which means rate changes are more reactionary in nature, not proactive. And also, the Fed is charged with evaluating the data independently with what's in front of them at the moment, and they've got to make decisions without influence from the executive branch. So it makes us all kind of, really question what they're going to do, and it remains to be seen how the Fed will actually react when it comes to setting future interest rates. Third, tax reform is likely to be the next big news out of Washington. An extension of Trump's prior tax cuts from 2017 is the most likely scenario, we believe. Legislators are likely to try to push this through as quickly as possible because Congress needs to enact a fiscal year 2025 spending agreement by March 14th, or the federal government may experience a partial shutdown. So, in other words, the debt ceiling is going to need to be addressed before that date, and it's likely that Republicans will want to address tax reform at the same time. The fourth thing you need to know has to do with concentration risk. We've been talking about this in our videos for quite some time, and the risks became even more clear in January as the top stocks in the S&P 500 were hit pretty hard. In fact, technology has been one of the worst performing sectors so far this year. The best performing sectors have included financials, healthcare, communication services, and also materials. They've performed substantially better than the overall S&P 500, which is lagging due to the concentration risk of what we call the Magnificent Seven tech stocks. You can see the Magnificent Seven stocks in red on this chart as they compare to the remaining 493 companies in the S&P 500. As of January 28th, the Mag 7 companies were down 1.4%, whereas the remaining companies were up 6.6%. Now, keep in mind that Trump's administration has said it's committed to making sure that the U.S. remains a global leader in the future of artificial intelligence. Only a few days after he took office, though, news from an AI startup in China by the name of DeepSeek announced that it had created a cheaper way to train its own AI models. So the news rattled the semiconductor sector, and names like NVIDIA took a 17% hit in a single session. That's why we're concerned about concentration risk. So, what can you do? Ultimately, I encourage all investors to look underneath the hood of their investment portfolios to make sure you understand your exposure to single company names and also any overconcentration to certain sectors, just so you can make informed decisions about the amount of risk you're taking. So, if this is something you'd like help with, we can certainly evaluate your investments and make recommendations for how to potentially position in the future. Also, keep in mind that no matter what's happening in the world around us, it's always best to prepare for better than expected outcomes at the same time that you prepare for worse than expected outcomes. This just basically means that your investment strategy should include an open minded and agile approach so that you can pivot quickly if needed. At EverThrive, that's the approach we take on behalf of our clients who give us discretionary trading authority. We do our best to evaluate strategies that may be warranted in contrasting environments in advance so that we can respond quickly and within our client's stated risk tolerance levels when conditions change. With that, thank you for watching and also for subscribing to our YouTube channel. We look forward to seeing you again next month.